Hello everybody and welcome to my finance and accounting education channel here on YouTube. My name is Alex Petrescu and today we are going to talk about investing for beginners. So the name of the presentation today is how to invest for beginners. I'm saying that it's never too late to start investing. Just a short wrap up, this is already the fourth presentation in a series what I like to call the basics of personal finance. We started with building a personal budget, so how to build a personal budget using your Excel and, if possible, your bank account statement. You can do it also when most of your monthly expenses and income sources are cash based, but it's more difficult. Then we went to another topic called how to get rid of debt, because most of the times debt is not a good idea. It's preventing you from saving, investing and growing your wealth. Then we had another installment of this let's say mini series called From Debt to Wealth, and today we are tackling this topic of how to invest for beginners. First of all, you need to know that everybody is a beginner at some point. Nobody was born with this knowledge or having acquired all the possible knowledge somehow else than just by learning it and learning and doing it. If you are a beginner, the first thing which you need to know is that the chances are that you don't have a lot of money, which is not such a good thing. You might think that, okay, I'm a beginner, I don't have that much money, that must be something bad. It doesn't really matter, and actually it can be seen as a positive if you are a beginner, and because you don't have that much money, because you cannot lose so much money. And the idea is that somehow your skills and your knowledge will upscale itself together with your wealth, so with the money that you own. And this is a positive thing because it's preventing you from losing a lot of money right at the beginning, and somehow okay, losing money is anyway a bad thing, but also making you withdraw from this and hence never allowing yourself to grow wealth. However, if you are, I'm saying that it might also happen that you might be a young investor or a beginner with a lot of money. It happens from time to time. Not many people win the lottery, or you can get an inheritance, and probably there are some other ways through which you can get a lot of money unexpectedly and not know what to do with them. And I'm saying that in such cases it's probably better to rely on somebody very, very close which you can trust, a relative or a very good friend, to take your advices from such persons, or even a trust or a specialized advisor that will tell you what to do with your money in order to protect your money. That would be the main concern when you are a beginner and you don't know exactly what to do. What I'm saying also, those are, like, let's say, two things which are very important for any investor, and they're not really available, so not relevant only for the beginners, but let's say that for the beginners they are of more value because the more advanced people know them already. You can also lose money for investment, so there is no 100% sure investment. You can always lose money, so yeah, take that into consideration, so in your mindset. And also when you are looking at, because this is one of the recommendations when you are doing an investment, and of course you are looking at the past performance to try and see what are the credentials, what kind of investment that is, and if it's a solid one or not that solid, and so on and so forth. You need to take into consideration the fact that past performance is in absolutely no way a guarantee of future developments or of future success. So there might be at some point a disconnection between, they can be disconnected, so the past performance and the future success, they can be disconnected at some point, and you might be the beneficiary, so actually you might be hurt because of that. So these are the 2 points which you need to take into consideration. Losses are possible, and past performance does not guarantee the future success. Now, if you are a beginner, first things first, you need to understand that there are multiple alternatives. I have somehow ordered them from, let's say, the less riskier to riskier ones, or less complex to more complex ones. Of course, you have the bank deposits. Current accounts, I wouldn't consider them as investments. Yeah, bank deposits are giving you a little bit of interest, so they can qualify as investment. Then you have the bonds. Usually the bonds come with a rating. They are issued by states, municipalities, large companies, and so on and so forth. Some of them, or most of them, are traded, so you have an active market for them. So if you want to stay in the more safe area, you should stay in this area. If not, the ones which are not listed, they are a little bit more tricky. Then you have, of course, the investment funds and pension funds and insurance funds. Let's say that it depends how risky they are based on what kind of risk profile they have, what kind of strategy they have. Investment funds, they diversify, they can hold monetary investments, let's say these bank deposits and bonds and things like this, so more safe investment, but they can also go into the direction of investing in shares and complex structure products and so on and so forth. There are 2 types of mutuals, are like the ones which are not listed, and personally I said also in the previous episode that I prefer them from the certain point that there is a direct connection between the value of their assets, so how they are investing, and the price you are getting for buying units in these investment funds. Then there are the exchange traded funds. Those are traded on the, just like other companies on stock exchange, and there can be this disconnection between their investment policy and what is the price of their units, so if you want to invest in them or withdraw your money from them. And then there are, of course, hedge funds. Hedge funds are, let's say, for the playground for the rich people. They also come with more risk than average, and they should deliver higher rewards, but they have limitations of who can come in most likely, or most of the times, in form of the minimum amount which you can put in a hedge fund and your minimum income. If you can prove that you are above these 2 thresholds, okay, the minimum amount is clear because you cannot give them less money than they are asking for, but also that you are above this minimum income level, then they will take you in, otherwise not really. And then you have the pension funds. We are talking about mainly, okay, there are, in general, there are 3 types of pensions. They are not available in all the countries, so there is this state pension for which you are paying your social securities, and when you are of a certain age, 60, 65, it doesn't really matter, you are getting a state pension. Then from this social contribution, sometimes a tiny portion is redirected towards private pension funds, so private administrators, and this will be the second pillar. So it's like a hybrid. Out of your tax portion, some private administrator, normally of your choosing, will give you an additional pension based on your contribution. And then there is, of course, the third pillar, which is entirely private, is your option. You establish a contractual relationship with this pension fund, and you are saving till the pension age, and then you are getting a pension. Then we have the insurance funds, but in this case I'm not talking about the, let's say, the third party liability, so the car insurance or the house insurance. I'm talking about the life insurances, especially if they have not only a protection component but also an investment component. So from what you are contributing, what you are paying throughout many years, at the end you are also getting a lump sum, which is usually, if you have many benefits in terms of cover for death or for accident, for unemployment, and so on and so forth, the less you will get at the end of the contract. And then of course you have the so-called unit-linked, which are otherwise also or very similar to investment funds because they are investing in the stock markets and so on and so forth. Then you have of course the shares, so you can acquire shares by yourself, so interested in companies. You have the real estate. With the real estate, okay, you have real estate investment trusts, which are also working like investment funds, but you are trying to acquire one or more properties, so houses or apartments or things like this, in order to either live in them, to rent them, or to wait a little bit till they get more expensive and to sell them with a profit. Or you can renovate them in the meantime, you can refurbish them, and whatever your strategy is. The real estate decision is one very complex, and unfortunately most of the time is not, let's say that not all the due diligence process is made when somebody is deciding to invest in real estate. Then you have the some other opportunities which are, from my point of view, more for trading rather than for investing in long term. Okay, let's say that the metals, you can buy metals like gold, silver, and so on and so forth, but there are also commodities and of course FX, so you can play a little bit with this exchange rate between various currencies. But if you are thinking trying to invest your wealth in this way, it's bringing you back to that current account, because you will have no protection against inflation. So you cannot really do that on long term. You need to trade it to always speculate and to make gains based on the exchange rate differences. And at the end you have the very popular nowadays cryptocurrencies. A little bit more about cryptocurrencies later. Then what you need to take into consideration as ground for each asset class and for each asset type is that they come with associated risk rewards and also liquidity levels. Liquidity means the possibility of turning that investment into cash very, very fast. Most of them are pretty liquid. Okay, let's say real estate in form of an apartment or a house is one of the most complicated from my point of view. Also, if you have these plans on a very long term, on many years, and you are not okay, maybe you can withdraw from them, but you need to pay penalties and so on and so forth, so these are not really liquid. Usually the higher the reward, the higher the risk. It's only natural. Also, you need to take into consideration this liquidity. It should also work that if an asset is more liquid, it should bring you less reward. So if you can just change it like this into cash, it should bring you less, let's say less rewards. But that's not really like that. I've seen differences within the same class of assets, or between the various assets within the same class of assets. If we are talking about different class of assets, that really is not really valid. Within the same class of assets, you can expect, if you are having a bank deposit on 3 months, let's say, it will be rewarded with less interest than one on 1 year or 2 years, and so on and so forth. It's the same if you are doing an investment plan on a very long term. You will buy also when so you will buy the dips also, and you will potentially have more than if you are just randomly investing at some points. And you can also invest when the market is at peaks, and then you will not get that many benefits. And also for holding shares, this intraday and between days fluctuations, and if you panic and you sell with the loss, and it's worse than usually holding them for several years and seeing the benefits of their actions of those companies in the market. But that's, just as I said, within classes, so within asset classes, so between deposits, bank deposits, between investment plans, between shares, so your behavior with the shares holding, or so if you are a long-term investor or not, and so on and so forth. Of course, you should start, since you are a beginner, you should start with less risky, less rewarding propositions. I know it's very, very hard. Everybody wants to go for the most benefit very, very fast. The idea is that hopefully by the time you are moving to more rewarding, more risky investments, you have also gained a lot of knowledge in between, and that can be very beneficial for you. And of course, the more you have, we said that at the beginning, usually you don't have that much. The more you have, the more you can diversify, so you can use multiple instruments. I'm using multiple, not all of them, multiple instruments from that list, and you can diversify. You need to think industries, regions, currencies, what specific assets. So even if you say you have shares, it's not a good idea to have all your money on one share, and you know, this kind of diversification, which is also reducing your risk. However, yeah, there is this temptation to go into the highest paying one. However, you will notice in time that the best rewarding ones are not really that many, so most of them are mediocre, and they will not offer you that many benefits. So there is always this quest of finding, of reaching diversification, or of being diverse, but within bounds of still having a serious growth of your wealth. Then operationally, so operative, what you need to do. I think that the best thing which you can do is you need to identify a bank, but not only a bank which is offering you current account and maybe some deposit, but one which is more advanced, one which is also offering you some investment opportunities, or some tools to support you in your investing. And I'm saying that many of the suggested investments from that list can also be handled through your bank account. Of course, the deposits, that's clear. Sometimes buying bonds is available, or exchange traded funds, pension funds, shares, and so on and so forth. Also, if you decide to invest in real estate in form of buying a house or an apartment, most of the banks will support you by offering you a loan, or a credit, a mortgage. So it's like a symbiosis. You are using the bank, and the bank benefits from you, and you are also growing your wealth. So you need to mind the cost, because owning a bank account, or several, or having this security account in a bank, so a securities account in a bank will cost you. You will have to pay fees, commission, transaction fees, and so on and so forth. But I'm saying that there are also other solutions which not necessarily involve a bank, which can help you at least save the transaction fees, especially if you have many transactions. Although if you are a long-term investor, like I just said, and which is by all means a better strategy than trading. Trading is not for everybody. The transaction fees will not be that high, because you won't do that many transactions. But there are alternatives like this modern platform, eToro, Webull, Robinhood, and there might be some others. However, be careful. Try to do some reading when you find one of these, and see if they are really serious, what the people are saying about them, if they are not just taking your money and then giving you nothing, which would be like a fraud. And you always need to be careful with your money. Then, just talking about being careful with your money, you need to avoid scams. If a proposal sounds too good to be true, so it's offering you very high rewards in very short term, then it probably is. I will be posting right now this video about Bitcoin, and actually it's about the blockchain, but there you have also a story about some lady that lost a lot of money by simply trusting one of these scams. We will triple your money in 1 week. In her case, we will double your Bitcoins and things like this. So try to avoid this. even if the temptation is very, very large and you are not very, very sure if it's real and so on and so forth, don't throw, and especially if you don't have that much money, don't throw all your money in, or even if you have a lot of money, don't throw all your money in something like this, because then you will regret it. Think that the money are hard to save. How long did it took you to save that kind of money? What kind of let's say things you gave up? What kind of goods and services you didn't consume? How much you struggled to save that money, and think if it's really worth losing them that easily. You can avoid, so because we were talking about cryptocurrencies earlier, if you are not okay with the class of assets, so for example you might not like shares, I see this here in Europe, at least the people are not that much oriented towards shares. For example, I was reading a headline the other day that okay, with the inflation, the people in Germany are going towards gold, so they have. And there are also videos in which I'm criticizing they're going towards current accounts and bank deposits because they are not really well rewarded. Now they are going towards gold, so they don't really like shares or investment funds or things like this. If you don't like, if you don't feel comfortable, just avoid those class of assets. It's okay. And I'm saying that personally, I'm avoiding cryptocurrencies. I know them very well since. Probably not many people knew what Bitcoin is and so things like this since 2016, when I was already reading some technical articles for my profession, the accounting treatment that should be given to such cryptocurrencies, because the profession was wondering if they are inventory, if they are cash or cash equivalents, if they are non-tangible assets, and so on and so forth. And although I have a lot of information, I know what they are and how they function, and I'm thinking sometimes that maybe, especially because I know how they function and what they are in reality, I don't feel very comfortable with investing in such type of assets, so any of them, and that it's okay. So you should not worry that much. I'm thinking every day, okay, how much money could I have made if I would have invested in 2016? But you should not have such regrets if you didn't feel comfortable with them, and you don't feel comfortable right now, and you shouldn't do it. Then how much is enough in terms of what kind of rewards you should get from your investment, what kind of level you should aim. I'm just saying that one ground rule is that you should cover for the inflation. So if a bank deposit or the current accounts most likely, but the bank deposit, if it's not covering you for inflation, you should avoid it. It's better to if you are if you are going in any type of investment that it's offering you a reward rate below the inflation, is better if you keep your money in the current bank account. Also, do mind the fact that sometimes, and at least in Germany, a lot of banks are offering now negative interest rates, so that will also will not be that beneficial for you. And sometimes you need to mind this market hype, or the fact that what is logic and objective behind an asset might not influence that much the evolution of that asset. I was just talking about these ETFs. They might have an outstanding investment strategy if the people that are buying their shares, let's say on stock exchange, do not believe, or they didn't heard about them, or they don't like them by so it's subjective. So from these subjective reasons, you will not make that much money with that specific exchange traded fund, although they might be very good at what they are doing. It can also go in the other way. I'm just giving over and over, I'm repeating this example of Tesla. I think that Toyota has a 12.7 market share. However, Tesla is at least 3 times more market value than Toyota. Toyota is the market leader. Tesla has 900 times less revenues than Toyota and 3,000 times less profits. And I said, okay, they will give you some explanation, just like they did with the dot-com bubble, that people don't understand the internet companies and we should not expect profits very, very fast, and we don't understand it, that it will happen in the future. It's not Tesla is not an auto company, and so on and so forth. So you know, this kind of explanations. The idea and what I think is that this hype led to such a share price that I said, okay, wake me up when Tesla will have 3 times the market share of Toyota, and when they will improve the profitability, and they will also have the 3 times the profits of Toyota. Until then, I will consider that they are overpriced, and I will never throw myself in that, no matter what kind of cyber trucks, what kind of self-driving cars, what kind of crazy ideas they come up with, because honestly, I don't believe that they will ever reach such a market share to be 3 times larger than Toyota worldwide. That's why I'm saying that the psychological factors do apply. So the underlying, let's say, the underlying conditions are not always relevant, or not the only relevant things to take into consideration. So that would be it about the investing for beginners. I think these are just some general advices. I'm going to link the first video in this 5-video series about investment opportunities, which is putting a spotlight on each of those investment opportunities. Also, the next videos will be about how to invest $1,000 or 1,000 euros, how to invest $10,000 or 10,000 euros, because there are differences depending on how much money you have and what you can do with them. Please do not forget to like this video if you liked it, to comment if you have something to add, to share it with somebody that you might think would be interested in the topics that I'm presenting here. And most important, do not forget to subscribe to my channel. I really need it in order to support me going forward. And also we have some links at the bottom of this video. An eToro, I just mentioned them, an eToro link. You can create an account and trade without fees and commissions. 2 offers from Amazon, 2 free audibles if you are into audiobooks, or joining the Kindle program, and also a wish list should you choose to support me with the quality of my videos. I could really use a better camera, some software, some latest version of Microsoft Office, some video editing software, some green screen, some light for my apartment, and so on and so forth. Once again, my name is Alex Petrescu. Thank you very much for watching me today, and I look forward to presenting to you next time. Goodbye.